What's up guys, this is Nick with Nick Does DGI and welcome to my channel where I cover all things personal finance, stocks, and real estate. In this video, we are going back to the basics. I want to show you the true power of dividend growth investing. So let's get into it. Investors often fail to appreciate the impact dividends can have on your investment portfolio. Dividends are the distributions of some of a company's earnings to its shareholders in the form of cash or additional shares. The strategy of dividend growth investing is simply the act of investing for dividend income and capital appreciation. When done correctly, investing in companies with a proven track record of rewarding shareholders through increasing annual dividend payouts year after year will allow you to accumulate serious passive income. And when all those dividends are reinvested back into buying additional shares, the total returns are compounded. Dividends play a huge role on the stock market's performance over time. Stocks paying dividends typically outperform non-dividend paying stocks. Going back to 1970, 78% of the total return of the S&P 500 index can be directly attributed to reinvesting dividends and the power of compounding. Dividend reinvestment just means that with each dividend payments you receive from a given company, you use the proceeds in return to purchase more shares in the company. Rinse and repeat. And to put this strategy to work, I'm going to model the forward-looking performance of one of my favorite dividend growth investing company, ticker symbol JNJ Johnson & Johnson. Johnson & Johnson is a proven dividend king with a 58-year dividend growth history with a well-diversified portfolio of brands and products. Take a look inside your medicine cabinet and you will most likely already own a Johnson & Johnson product. It currently trades for about $150 with a dividend yield of around 2.64%. Its 10-year compounded growth rate, or CAGR, is 6.87%. And I have no doubt that Johnson & Johnson will continue to grow its dividends for the next 50 years. Next, to help you further visualize the power of compounding your dividends, I want to show you two examples. First, a one-time investment into Johnson & Johnson with and without dividend reinvestment, and second, an initial investment with monthly contributions into Johnson & Johnson with and without dividend reinvestment. We will be projecting out 30 years using the 10-year CAGR rate of 6.87, which in my opinion is a conservative but realistic expectation of dividend growth in the future. In our first example, we will assume a one-time only $1,000 investment at year 1 and run two simulations with and without dividend reinvestment. By year 30, that $1,000 investment into Johnson & Johnson has grown to $15,372.21, whereas without reinvestment, the total difference or the total investment by year 30 is only $7,339.63, a difference of over $8,000. And as far as passive income goes, a one-time investment into Johnson & Johnson with dividend reinvestment is $405.83, or nearly 40% of your initial investment in a single year. And without dividend reinvestment, your annual dividend growth by year 30 is only $193.77. In our second example, we will be projecting 30 years out with the same initial $1,000 investment, but this time, invest an additional $200 each month, or $2,400 a year. With dividend reinvestment, the amounts will have grown to a total of $377,079.28 by year 30. Without dividend reinvestment, your total by year 30 is $228,811.49, a difference of almost $150,000. But let's take a look at the future dividends you would be receiving. By the end of 30 years, you would be receiving $9,954.89 each year and growing. Without dividend reinvestment, your annual dividend income by year 30 is only $6,040.62, a difference of almost $4,000 annually. And the longer you have the money reinvested, the higher your annual income will grow. Now that you have witnessed the extra snowball effect of dividend growth investing and what it can do for your portfolio, let's see what would happen if you were to keep this up for another 5 or 10 more years. Assuming our second scenario of an initial $1,000 investment and then investing an additional $200 a month with reinvestment enabled, you can see that by year 35, your total investment nearly doubled to $609,113.63. And give it 5 more years, by year 40, your total investment grows to $974,996.14. With more time in the market, the compounded growth is exponential. And this growth is also apparent when projecting out your future annual dividends. By year 35, your annual dividend income is $16,080.60 in a single year. And by year 40, your annual dividend income is $25,739.90. Time in the market is imperative, and this scenario is perfectly attainable if you are able to start your investment career at an early age. And to sum it up, dividend growth investing takes time because you don't see the compounded effects until at least the 15 or 20 year mark. This strategy also requires discipline because you must continue to invest when the market is doing well and alternatively when the market is falling. And with most things in life, there is no such thing as a free lunch and requires hard work now in order to set yourself up for a future passive dividend income source. I hope this video helped some of you understand the dividend growth investing strategy. If you enjoyed the content, please consider smashing the like button, subscribing to the channel, and clicking on the bell notification to receive all the latest video alerts. Have a good one. Bye.